In this lesson, you're going to learn about how to calculate the unlevered beta for each of our comparable companies, and then how to use this metric as part of our DCF and WACC analysis here. Now, this lesson introduces a lot of new terminology and some new concepts. So to explain the motivation for this, remember that in the previous video on the overview of WACC, weighted average cost of capital, we said that the basic idea here is that we want to look at the cost of equity, debt, and preferred stock. The cost of the last two is straightforward. We can just pull the interest rate from the filings for both of those. So it's really the cost of equity here that's problematic to determine. What we generally use for our approach to find the cost of equity is we take our risk-free rate and then we add in the equity risk premium, representing how much over the return expected on safe investments that anyone investing in stocks or equities is expected to get with their investment. So we take those two numbers and then we adjust the equity risk premium for company specific factors. This 7% number over here is fine, but that just represents what return we can expect on the market overall. The relevant question here is what kind of return can we expect by investing in Apple's stock or on the stocks of similar companies? And we're going to use this analysis to get there. We're going to actually figure out what this adjustment we need for company specific factors is. And so the way we adjust for it is by using what's known as beta. In this case, we have levered beta and then we have unlevered beta over here. So we're going to have to use both of these, but the concept here is very simple. If our beta is 1, that means our company is about as risky as the market as a whole. So we'd expect around a 7% return, and that would be our equity risk premium for this specific company. If our beta is 2, then we'd expect a 14% equity risk premium because a beta of 2 means that our company is twice as risky as the market as a whole. So all beta is measuring is risk of a company and the expected return of a company's stock relative to the market as a whole. So if the stock market goes down by 10% and the company's beta is 2, we would expect its stock to go down by 20%. If the stock market goes up by 10% and our company's beta is 2, we'd expect its stock to go up by 20%. So that's all beta is telling us. So what we need to do now is figure out, using the beta number for these comparable companies and looking at Apple's own historical beta, what kind of return can we expect and what kind of numbers should we be using for cost of equity in this calculation for WACC? So what we want to do here is first get the numbers for beta, for levered beta right here, from publicly available sources. And literally what we do here is we just look at each of the comparable companies, look up their information by their tickers, and we just enter the information on their levered betas right here. To show you an example of this, let's go to Google Finance. And I have up here Apple, and we see right here beta 1.57, which is exactly what I have listed for Apple right here. So we can literally go to Google Finance and look up the betas for all these companies right there. And that's telling us when you take into account a company's debt and equity, how risky is it relative to the market as a whole. Now, in investment banking, when you're doing this, normally you don't use Google Finance, you use Bloomberg, and you come up with a more precise calculation. But we do not have that, and you don't have access to that unless you pay thousands of dollars. So we're just going to stick to Google Finance for pulling these numbers for now. Now, I mentioned that levered beta tells you how risky a company is when you take into account both its equity and its debt, because that's just how this number is displayed. That's how you always see it on Bloomberg and other sources. But what we want to do here is actually figure out how risky is just its equity. So if we take out the additional risk imposed by the debt, then how risky is the company without that debt? How risky is it in terms of its unlevered beta? Now, rather than giving you the formula right away here for figuring out unlevered beta based on levered beta, debt, equity value, and tax rate, what I'm going to do instead is walk you through intuitively how this formula works and how the concepts of levered beta and unlevered beta are related. So I would think of it like this. Levered beta is equal to unlevered beta plus unlevered beta times 1 minus the tax rate times debt over equity. So what we're doing here is we're saying that levered beta, a company's risk from both equity and debt, is equal to its risk from just equity right here, and then it's equal to its risk associated with debt. So the additional risk a company takes on as a result of debt. Why is debt risky and why does debt add risk to a company? Well, if a company has debt, it has to make interest payments, it could default on the debt, it might have to repay some of the principal, and there are a lot of other bad things that could happen to a company potentially if it has debt versus if it just has equity and is not using any type of debt financing on its balance sheet. So debt is always going to add to your risk when you have a company like this. I usually get a couple questions with this formula, and specifically with the second part here, where we look at unlevered beta and then we adjust by figuring out what kind of risk contribution that debt here is actually making. The two questions I usually get on this formula are why do we multiply by 1 minus the tax rate, and then why do we multiply here by debt over equity rather than debt over equity plus debt is usually the standard question I get on this. So to address the first one first, we multiply by 1 minus the tax rate because the interest paid on debt is tax deductible. So when we pay interest on debt, remember that in our three-statement model over here, the interest on debt shows up just before pre-tax income, and when we apply a tax rate to a company, we're taking into account this interest expense or interest income right here. So that explains that part in the formula. And we're multiplying by 1 minus the tax rate here because if a company gets taxed, which all companies do, and it has debt, the tax effectively reduces the risk of that debt because the tax there means that the company is not going to have to pay as much in terms of the interest on debt as they would if they did not have that tax rate. So for a simple example here, think about if a company had 100 million of debt and they owed 10 million in interest each year, they have a tax rate of 40%. Well, if they did not have that tax rate of 40%, then effectively they'd be paying out that entire 10 million in interest each year. But with a tax rate of 40%, effectively what's going on is that via taxes and the tax break they get, they're saving around 4 million each year, which makes the company less risky overall. So the effect of the tax rate here is to reduce the risk of the burden of debt, the burden that debt places on the company. And that's why we multiply by 1 minus the tax rate here. Now, in terms of why we multiply by debt over equity rather than just debt over equity plus debt, this is one of the most common questions I get on this formula. The reason we multiply by the first one here, by debt over equity, is because if we use the second one, we'd be undercounting the additional risk that debt imposes on the company. The reason for this is because when we take on debt, we're not interested in the effect of debt in relation to the company's entire capital structure. We're only interested in the proportion of debt to equity and how that affects the risk. So to show you an example of how this formula works, I'm just going to go through a quick example here of a few very simple numbers that we can use in our calculation for levered beta and unlevered beta here. And I'm going to show you why we need to use debt over equity rather than debt over equity plus debt. So let's say that we have an unlevered beta of 1. So the company is about as risky as the market as a whole. We have a tax rate of 0% in this example, just for simplicity. The company has an equity market cap of 100, and currently they have 0 worth of debt. So let's just think about this calculation for levered beta. What we would do here is take the unlevered beta of 1, we would add the unlevered beta times 1 minus the tax rate. In this case, it's 0%, so we just have 1 there. Effectively, it just goes away. And then we multiply it by the percent debt over equity. In this case, we have 0 worth of debt, so it's just 0 divided by 100. And what happens here is that the levered beta is exactly equal to the unlevered beta because we have no debt in this case, so our unlevered beta and levered beta should be the same. But now what we want to do is look at the same scenario and say that the company has now raised 100 worth of debt. Now if the company has a market cap of 100 and they raise 100 worth of debt, and assuming a tax rate of 0%, this should make the company twice as risky overall. So now let's go in and modify these numbers in this formula. So we still want to be taking the unlevered beta of 1 here, adding unlevered beta times 1 minus the tax rate. But now what we want to do is rather than taking 0 divided by 100, we now have 100 worth of debt on our balance sheet. So now what happens is that our levered beta becomes 2. So now the company is twice as risky because it has raised debt equal to its market cap here. And that's the real reason that we need to be using debt divided by equity rather than debt divided by equity plus debt. If we use the latter, if we said 100 plus 100 right here, we would get a levered beta of 1.5. This is not accurate because if a company has a market cap of 100 and they raise 100 worth of debt and the tax rate here is 0, then this company should be twice as risky because it now has debt equal to its market cap. Half of its capital structure is now taken up by debt. We want our levered beta here to be 2 rather than 1.5, and so that is why we use debt divided by equity rather than debt divided by equity plus debt for this levered beta calculation. So that explains the motivation for why we have this formula. We're taking the company's risk without debt, and then to figure out the contribution that debt is making, we're taking that number, multiplying by 1 minus the tax rate to take into account the fact that taxes reduce the risk of debt, and then we're multiplying by the company's leverage ratio, debt over equity, because we want to look at how much debt the company has in proportion to its equity, not in proportion to its entire capital structure. We want to only look at debt in proportion to equity because we want our factor here to be right. We want to make it so that if a company raises as much debt as its current market cap, it's now twice as risky, and that's why we use that in the formula here. So that's an overview of the levered beta and unlevered beta formula and why we use this exact formula when we're actually calculating levered beta and unlevered beta for our purposes in cost of equity. With that explanation out of the way now, what I want to do is show you the formula that we're going to use to find unlevered beta here. And what we're going to do is take this levered beta formula and just apply some basic algebra. So we're going to factor out this unlevered beta right here. So I'm going to say levered beta equals unlevered beta times 1 plus 1 minus the tax rate times debt over equity. So all we're doing here is just factoring out the unlevered beta. You should know this from basic algebra. So now what this formula is telling us is that levered beta is equal to unlevered beta times this factor over here. So with this in place, what we can now do is calculate unlevered beta simply by taking this factor, putting it on the other side of this equation, and dividing levered beta by this factor over here. Again, just using very basic algebra. So what we can now say is that unlevered beta equals levered beta divided by this factor right here. And so that's our formula for unlevered beta, and that is how we derive it and how you can think about this formula intuitively and how we actually get to the real formula we use in this analysis. So what we're going to do now is now apply this formula to each of these companies. So for the first one, Hewlett-Packard, what we're going to do here is take our levered beta and then divide by 1 plus 1 minus the tax rate right here, and then multiply by the debt to equity ratio. So debt divided by equity right here. So we get to their unlevered beta of 0.94. This makes sense because Hewlett-Packard actually has debt here. The levered beta is always going to be equal to or greater than the unlevered beta because, again, debt always adds to the risk of a company. So all else being equal, levered beta is always going to be equal to or greater than unlevered beta. So this formula makes intuitive sense. What we can now do is simply copy this one down using Alt-ESF. You can see what unlevered beta comes out to for each of these companies. Each of these companies actually happens to have debt, and we can see that in each case here, the levered beta always exceeds the unlevered beta. Because once again, just from basic corporate finance and common sense, debt always adds to your risk. So that's why the levered beta in each of these cases always exceeds the unlevered beta. The last thing I want to do here is just do a median on the unlevered betas. And as we'd expect, the median unlevered beta is less than the median levered beta right here. So what this now gives us is, going back to the cost of equity formula, we want the risk-free rate plus equity risk premium times adjustment. We are now close to getting this adjustment factor right here because we've seen on average what the adjustment should be for the comparable companies. What we need to do next is take this adjustment factor of the 1.16 and apply it to Apple. So apply it to Apple's own capital structure, and then we'll be done and we'll have the adjustment factor, the beta number here, that we're going to use in our calculation for cost of equity. A few other notes on this calculation. For debt and equity value right here, we should be using the market values for both of these. We are using the market value for equity value right here because we're pulling the share price from current data on this date. So we're using the market value from there. For the debt, we're not really using market values. We're just taking these numbers from filings. Technically, you should take the market value of debt here. The problem is that it's almost impossible to find this with publicly available information. And oftentimes, even at an investment bank, you simply take the debt numbers from the company's filings. If you can somehow find this with Bloomberg or another source, go ahead and use the market value. But in this case, even though we should use the market value, we're just going with the book value because we cannot easily access that kind of information, at least with freely available public sources. For the tax rates, I've simply taken these from the company's filings based on their effective taxes and their pre-tax income numbers. You could just use standard statutory tax rates of 35 or 40% here as well. It's really up to how your bank does it. I've seen it go both ways with this kind of analysis. Here, I'm just using the effective tax rates based on our public company comparables, though. So now you should have an overview and an understanding of how we actually calculate levered beta and unlevered beta in the context of this WACC analysis and how it fits into the big picture of getting to cost of equity right here. Coming up in the next lesson, we're going to be taking a further look at this adjustment factor. And what we're going to be doing is, now that we've figured out on average the median adjustment needed for the comparable companies here relative to how the market as a whole is going to perform, we're going to take this adjustment factor and now make sure that it's appropriate for Apple by adjusting for their own capital structure.